Hi, in this video we'll talk about computing earnings per share, diluted earnings per share with a complex capital structure. So a business has a complex capital structure when they have some convertible securities that can be converted into common stock, or they have outstanding stock options or warrants. In either case, what you have there is if the people exercise those options or warrants, or if they exercise their option to convert the bond into a common stock, they're going to dilute ownership in the company, right? The company is going to be split into more pieces, going to have more shares. So it's only fair then to report regular earnings per share and then alongside it report diluted earnings per share. So this is what the earnings per share would be if everyone exercised their stock options and our convertible bondholders all converted. This is the worst case scenario. Okay, and that's important to do. Okay. So this is kind of a graphical illustration here. You have the basic earnings per share and then diluted there, which diluted takes into account the impact of convertible securities and stock options. One thing important to note here, guys, companies don't report diluted EPS if the securities in their capital structure are anti-dilutive. So anti-dilutive means that if people exercise those options, the earnings per share would actually increase. That's anti-dilutive, if it would actually increase the earnings per share. Okay, so when you have, we'll first talk about when you have convertible securities. We measure the dilutive effects of potential conversion using the if converted method. We're going to assume, what if everyone converted? Here's what else we're going to assume. We're going to assume the conversion occurs at the beginning of the period. Okay, so you're reporting, say, for December 31st. We're going to report diluted EPS assuming what if they had converted on January 1st of that fiscal year. Okay, maybe they did, maybe they didn't, but we're going to report as if they did. Now, sometimes you issue convertible securities in the middle of the year. Maybe you issue bonds in August or April or whatnot. If that's the case, you're going to assume they converted at the time of issuance of the security. Okay, so if they issued something on May 1st, you're going to say, well, what would earnings per share be if they had converted on May 1st? As soon as we issued the bonds to them, they immediately converted to stock. Okay. And this is important to note, guys. If your bondholders convert to common shareholders, you no longer have to pay interest on the bond. So we're gonna take that into account on our earnings per share formula at the top, the numerator. We're gonna say, okay, that interest is gonna be eliminated net of tax. And you'll see what I mean about net of tax. Okay, so if you don't have to pay $100 of interest because they converted, you're not actually saving the whole $100. Because keep in mind, if you had to pay the $100 of interest, you would have saved some money on your taxes because interest on debt is tax deductible. All right, so if you say you save $100 on interest, and let's say what's the tax rate? Let's say 35%. Well, then you don't save the whole 100 because you would have, if you had paid the interest, you essentially would have paid $35 there. But you would have saved $35 on taxes. So you save 100, but then you lose the $35 tax saving. It's kind of like plus 100, but minus the 35. So in that case, you only save 65. Okay. And let's do an example so we can see what we're talking about here. All right, Mayfield Corporation has the following information. They have net income of $210,000, and they have 100,000 weighted average common shares outstanding. So they've done the hard work for you. They just tell you the weighted average number there is 100,000 for the year. They have 2 convertible debenture bonds outstanding, Bond 1 and Bond 2. Okay, let's have a look at them. Bond 1 is a 6% issue sold at 100, so sold at par, total of $1 million in a previous year. It's convertible into 20,000 common shares. And of course, the interest expense on the 6% bond is, of course, $60,000. Bond 2, a 10% issue sold at 100, so sold at par again, on April 1st. It's $1 million total of the current year. So this one's issued in the middle of the year. All right. It's convertible into 32,000 common shares. The interest expense, of course, is $75,000, and the way they got that was they took the 1 million times the 10%. But of course, it was issued in the middle of the year. It was issued on April 1st. So then they said, okay, well, you only have to pay interest, of course, on 9 months out of 12. And so that's how they got the 75% there. Okay. So, I mean, $75,000. The tax rate is 40%. Okay, tax rate is 40%. That's going to be important to remember as we go into the next slide. All right, so first off is basic earnings per share. That's easy. Net income is $210,000. They didn't mention anything about having preferred stock, so I'm just going to divide that by the weighted average common shares of 100,000. $2.10. All right. And so then what we're going to do for diluted earnings per share, first we have to recalculate the denominator. That's the first step I like to do. So originally we had 100,000 common shares, weighted average outstanding during the year. But suppose the bondholders had converted. So if that was the case, we'd have to change the denominator a little bit, right? Because if they convert, you're going to have more shares outstanding. Bond 1, remember bond 1 is issued in the previous year. So we're going to assume it's converted on January 1st. And it's converted into 20,000. So that's 20,000 for the whole year then. That's outstanding for the whole year. Remember, bond 2 is issued on April 1st. It's convertible into 32,000 shares. So those 32,000 shares were outstanding for 9 out of 12 months of the year. So the weighted average there, you're looking at an increase of 24,000. So 32,000 times 9/12. So the total, the new denominator, it should be 144. Okay. All right. So here's what we're going to do. I like to draw a big line on my paper when I do diluted earnings per share. I highly recommend this. And there's going to be a lot of parts to it, okay? So make a big line. Maybe turn your paper sideways and horizontally. Start off with the basic. All right? You fill that in. And now let's add the effects of each convertible security one by one. That's basic EPS. The 6% bonds, bond 1 here. I'm going to add $60,000 that I would not have to pay in interest expense. But I'm not going to add the whole $60,000. I'm going to take $60,000 times 1 minus the tax rate. All right, and here's the deal. Your net income would be $60,000 higher? No, not exactly. It would be $36,000 higher. And the reason that is because of taxes. So by not paying the $60,000 of interest expense, you are saving $36,000. Okay. Because again, interest is tax deductible. And as a result, we covered on the last slide, your weighted average shares outstanding will go up by 20,000. Okay. Bond 2, issued in the middle of the year. Remember, bond 2, we are saving $75,000 of interest expense. So that's the 100,000 times the 9/12, 75,000. And so your net income would go up by 75,000 there times 1 minus the tax rate again. Okay? For the same reason. for the same reasons discussed previously. And again, because they converted on April 1st, your weighted average common shares outstanding will go up by 24,000. Remember, that is just the 32,000 weighted by 9/12 of a year. Okay, so your diluted earnings per share is $2.02, and since that is lower than the basic earnings per share of $2.10, you would definitely report that. Okay, that'll be enough for this video.